A sudden 2-week ceasefire between the United States and Iran, brokered by Pakistan, has hit the global markets. The immediate result was the total evaporation of the geopolitical risk premium. The primary mechanical shift enforcing this truce is the reopening of the Strait of Hormuz. For the next 14 days, the critical maritime choke point resumes commercial traffic under Iranian military oversight. The commodities market priced in this reopening instantly. The $15 to $20 per barrel security premium attached to physical crude oil vanished from the order books. This chart tracks that specific liquidity flush. We see a vertical 13% collapse in Brent Crude, plunging directly from its $108 resistance ceiling to sub-$95 levels. Algorithmic trading models reacted to the price collapse by executing massive automated sell orders, flushing out defensive positions heavily weighted in energy and defense. Safe haven capital immediately exited the currency markets.
The DXY dollar index dropped to 98.97 as institutional cash rotated back into risk assets. A sudden geopolitical de-escalation acts as a reverse black swan. It instantaneously resets first-quarter stagflationary fears, replacing pure market panic with high-frequency, calculated volatility. The immediate beneficiary of this liquidity flush is the United States equity market, specifically high-beta technology and semiconductor shares. Pre-market institutional capital rotated aggressively, driving S&P 500 futures up 2.5% and Nasdaq futures up 3.1% in a matter of hours. The sudden drop in energy inputs technically invalidated the war stagflation narrative that had suppressed large-cap tech valuations for the past quarter. On this S&P 500 candlestick chart, the index reclaims the 6,700 level on heavy volume, destroying the bearish descending triangle pattern. The floor is now established at 6,600, with a new resistance ceiling at the 6,850 pre-war peak. Options markets reflect the shift in sentiment. The VIX has cratered 2.7% to 23.87, confirming the transition from extreme panic to risk-on deployment. This breakout is a high-velocity short squeeze, fueled entirely by the sudden removal of an energy shock. It is a tactical reaction, not the foundation of a structural bull market. During the maritime blockade, resource-poor Asian manufacturing hubs were the primary victims. Now they are absorbing the heaviest inflows of capital. For the Japanese industrial core, sub-$95 crude oil is an emergency tax cut. It dramatically lowers the overhead cost of heavy manufacturing and logistics. The result is a violent mean reversion in Asian equities. South Korea's Kospi soared 5.9. With heavyweights like Samsung forecasting 8x profit growth, the index is targeting major resistance at 57,500. While equities rally, the currency tells a different story. The USD-JPY pair remains stalled at 158.41, deep in the Bank of Japan's intervention zone. However, plunging energy import costs alleviate the immediate inflationary pressure on the yen, giving the central bank room to delay imminent rate hikes. The Asian market surge is a pure operational margin expansion play. Every dollar dropped in Brent Crude translates directly to restored corporate profitability. As the shadow over Hormuz lifts, the Indian equity market staged its largest single-day point gain in history. This Nifty 50 chart shows a massive breakout. The index gaps up 795 points past the 23,300 resistance wall, reclaiming all moving averages, while the weekly RSI violently recovers from an oversold trap at 27.88. The macroeconomic math is straightforward. Over the 14-day truce, the government projects a savings of 1.5 lakh crore rupees in energy subsidies and import costs. The domestic wall of money absorbed the sell-off. Domestic institutional investors injected 7,448 crore rupees into the market, easily countering heavy foreign outflows. Options market mechanics accelerated the momentum. Massive call unwinding at the 23,500 and 23,800 strikes forced the total capitulation of bears. Sector rotation was highly specific. Autos, paints, and oil marketing companies captured the immediate energy dividend as tactical leaders. A robust domestic SIP engine kept the baseline stable. When the geopolitical catalyst hit, that fundamental input relief weaponized into a 14 lakh crore rupee wealth gain in just 2 hours. The reaction across European indices provides a perfect case study in cross-market arbitrage, where one macro event forces severe divergence. This split chart illustrates the divergence.
The German DAX 40 rallied 4.88%, as restored LNG supply chains allowed energy-intensive sectors to breathe. Conversely, the UK's FTSE 100 dropped 0.84%, dragged down by energy giants like BP and Shell, suffering immediate derating as crude tumbled. The Saudi TASI index acts as the global lagging hedge. It dropped 1.55%, effectively pricing in the end of the supply squeeze windfall. The TASI is currently testing its 10,800 support base. A technical failure here threatens a deeper move down to the 10,500 demand zone. Internally, Middle Eastern funds are executing an asset rotation. Capital is shifting out of pure energy plays and into the banking and petrochemical sectors. Index composition determined the outcome. Industrial-heavy markets experienced explosive relief, while commodity-heavy indices suffered immediate fundamental derating. The ceasefire provides margin relief, but it does not fix the underlying structural headwind, the Federal Reserve's unwavering higher-for-longer interest rate policy. This dual-axis chart highlights the divergence. While the S&P 500 surges, the U.S. 10-year Treasury yield stubbornly holds at 4.31%, exerting continuous macroeconomic gravity. Indices are rapidly approaching their pre-war psychological ceilings, specifically the Nikkei at 56,500 and the Nifty at 24,000. Traders must watch closely for bargain buying exhaustion. Confusing a temporary operational tax cut with a permanent macroeconomic pivot is a fatal error for institutional capital deployment. The current short squeeze have a hard geopolitical deadline. The ceasefire agreement is strictly a 14-day tactical window. The climax of this timeline hits on Friday, April 10th, when U.S. and Iranian delegations enter formal negotiations. Prime Minister Shahbaz Sharif will host the talks, acting as the critical third-party mediator attempting to anchor regional stability. The outcome in Islamabad is entirely binary. If the delegations fail to establish a permanent multi-point roadmap, the physical supply squeeze and its accompanying premium will aggressively return to the market. Professional trading desks recognize the limit. They are keeping a tactical-only tag on this rally, front-running the talks rather than buying into a structural shift. Global capital is currently suspended in a high-stakes waiting game, holding its breath for a geopolitical binary event in Pakistan.